In the world of accounting, we don't just record what happened yesterday. We make a massive, fundamental assumption about tomorrow. We assume that the lights will stay on, the doors will stay open, and the wheels of commerce will keep turning. This is known as the going concern principle. The going concern principle is the bedrock of modern financial reporting. It is the assumption that an entity will remain in business for the foreseeable future, long enough to carry out its objectives and fulfill its legal obligations. But why does this assumption matter so much? Because without it, the values we see on financial statements would look radically different. To understand the value of the going concern, we must look at its opposite, liquidation. If we knew a business was closing its doors tomorrow, we would value its assets at fire sale prices, whatever we could get for them in a hurry. However, under the going concern principle, we don't value a delivery truck by what a junkyard would pay for it today. We value it based on its ability to generate revenue over the next 5 years. This principle allows us to shift our focus from scrap value to operational value.
This principle is the reason we use historical cost. Imagine a company buys a specialized piece of manufacturing equipment for $1 million. If the company were closing, that machine might only be worth $200,000 to a liquidator. But because we assume the company is a going concern, we record it at the $1 million price tag and gradually reduce that value through depreciation over its useful life. The going concern principle justifies keeping that $1 million asset on the books because the business intends to use it to make money, not sell it for parts. The going concern principle also gives birth to accrual accounting. Since we assume the business will exist next year, we can defer expenses and prepayments. Think about an annual insurance premium. If we pay $12,000 in December for the upcoming year, we don't record the full expense immediately. We record it as a prepaid asset because we assume the business will be around to benefit from that insurance in July, August, and September of the next year. Without the going concern assumption, every cent spent would have to be treated as an immediate loss. Accountants and auditors are the guardians of this principle. Every year, when an auditor reviews a company's books, they must ask, is there substantial doubt about this company's ability to continue as a going concern for at least one more year? If a company is drowning in debt, losing its biggest customers, or facing massive legal battles, the auditor might issue a going concern warning. This is a red flag to investors that the fundamental assumption that the business will stay open might be breaking down.
What happens when a company isn't a going concern? If bankruptcy is imminent, the accounting rules flip. The company must switch to the liquidation basis of accounting. In this breakup basis, assets are no longer recorded at cost. They are written down to their net realizable value, the actual cash the company expects to receive from a forced sale. Liabilities that weren't previously recorded, like severance pay for employees or penalties for breaking leases, suddenly appear on the books. It is a grim, realistic look at the end of life for a business. For investors, this principle provides stability. It allows for the calculation of long-term ratios and valuation models. If we didn't assume businesses would stay open, the stock market would be a chaotic place of constant fire sale valuations. The going concern principle allows us to value a company based on its future earnings power. It shifts the perspective from what is this company worth if we killed it today to what can this company create over the next decade. Ultimately, the going concern principle is a necessary leap of faith. It is the silent agreement between accountants, businesses, and the public that the future is worth planning for. It turns a collection of desks, computers, and inventory into a living, breathing entity with a future. By assuming the business will stay open indefinitely, we create a framework where growth, investment, and long-term strategy become possible. The going concern principle is more than just a rule. It is the heartbeat of financial confidence. The going concern principle is the thread that holds the fabric of the financial markets together. It allows for long-term investment, multi-year projects, and the stable reporting of assets. It is the language of persistence, the formal way of saying that despite the risks of the market, we believe this business has a future. Without this assumption, the world of finance would be focused only on the end, but with it, we can focus on the journey of growth and sustainability.